11 and 12%, right? We ain't even talking about that. So basically, the story is you all need to seek out real estate brokers that are veterans in the industry like us in order to make your move. Don't Google, don't phone a friend that bought a house in 2008 and wait for the market to crash, and it's not going to happen, right? You have to, real estate is forever changing. And typically, like when rates went low, right? That was COVID. It's traumatic things that happen in our country that we get these crazy results. And you have to pay attention to the full picture of what's going on in the financial world as to what you need to do at that time. So COVID hit, that was the time to get as many loans as you could for the 2%, because that was 1950s.
Or refinance, which I lost that on.
Yeah, refinance. And then the other portion, like in '08, when the market crashed, right? A lot of people, oh, it's so bad, I don't want to buy. No, that was the time to buy. That's when I just tell you guys, I was in college. I started purchasing properties in 2008, and I will tell you, those properties made me a millionaire. And I was using like my student loan money that I saved up from financial aid. Like I was scraping the pennies. I didn't even have a job. And I was coming up with what we call today creative financing on how to purchase these properties. And I still have those properties today. And that was '08. So '08 provided an opportunity for a young girl like me that came from nothing, from the housing projects, to get her foot into real estate. And I've never left. I'm just continue to learn more, develop, and just to continue to be that subject matter expert. And so when you want to do stuff in this industry, you need to come to like InvestFest. You need to get with the subject matter experts. We are just in a place where as veterans, as minorities, that we have to help each other because there's too many other people trying to take advantage of us. So seek someone out to really, because it's so many gems that we could drop, but of course I know we only got limited time, but yeah.
But it's scary. Real estate is scary, but it's never going to not be scary. You just got to take that leap of faith.
No, that's wonderful stuff. So, because one of the things that happen, right, like when you go in and buy a car and they trying to get you to buy a car, they don't even talk about the price of the car, right? Yeah, right. Interest rates are crazy on the cars, right? And y'all going out and financing those, right? Yeah, they make it easy for you. But even with that example, what they're focused on you is they're focused on how much can you afford monthly, right? And you shouldn't be thinking about it that way because that interest rate is so high. But when you looking in terms of your house, you should actually be thinking about it that way. What is that mortgage payment that I can afford? You shouldn't be dissecting what the interest rate is and how much the home price costs. What can I realistically afford? And then purchase a house based on what you can realistically afford, and then you'll be good. Because what's going to happen when interest rates go down is the price of the home is going to go up. You're going to have the same mortgage payment anyway. Just like they were explaining, when you have more competition, you had to pay above appraised value, waive contingencies, all those different things. However, you buy a house now, higher interest rate, VA Loan has a special refinance program where you can actually go refinance if it drops significantly. So you're really getting the best of both worlds by buying a house with a higher interest rate because you got a lower price on the home. So you got the lower price of the home now, and then you refinance, and now you got that lower interest rate. You're never gonna find that bubble where you're able to get both at the same time. That's a unicorn that really don't exist. You're either gonna have a higher interest rate or you're gonna have a lower price on a purchase price. You're never gonna really get both at the same time because that's not how the competition in the market works. It's a supply and demand, and just nationwide, we're at a housing shortage, right? So what's gonna happen, interest rates are gonna drop, then more competition in the market, they're just gonna raise the price. So to give you an example of that, so if you're buying a home for $500,000 at a 7% interest rate, right? What's going to happen if it drops to 5%? That house is going to go up to $650,000, and your mortgage payment is the same.
And the interest rates are 7%. I could get that $500,000 house for $485,000. Like, sellers are more determined to get rid of that house, so they're more apt to negotiate with you. I can get your closing costs paid. I can get your home warranty. I can get you carpet credit. So it's so much you could do. I feel like it's so much leverage once the interest rates are high.
Yeah, and so anytime the rates are high, it is the season of leveraging, right? Getting what you can get. it is a time to take advantage of leveraging. When the demand was so high, you couldn't leverage anything. You had to have cash to come in the game and play. And if you didn't have cash, you were getting beat out. People putting in 15 offers and wasn't winning anything. So you have to pay attention to the market. Do not listen to the media. Do not listen to your friends. You have to pay attention to the market. And it's crazy. You were mentioning the vehicles. Some of these people got 19% interest rate on these cars, like a BMW. I've had clients who've had mortgage. Their cars are just as much as their mortgage payments, right? You got people running around, what is it, assets over liabilities, right? We need to focus on buying things that cash flow us versus buying things that serve our car serves a purpose for you to get to A to B to be able to do those investments, right? So, and yes, I'm not gonna lie, I have a nice car, but I also have a 2012 that I refuse to get rid of. And I'm going to continue. I can afford a better car, but at the end of the day, my priorities are creating cash flow, taking my money, and putting it in places where it can make money. Money is nothing but a tool. You should only be using money to make more money. The more you have, the bigger your tool is, the more money you can produce, the faster. So at any time, when you start letting money go out, it's dead money. Why are we working jobs to kill our money? Like, we're serving our country, we put our lives on the line to what? To kill our money? No. You got to keep the energy and you got to keep the heartbeat of that money by investing it into something else that's going to produce you more money. Then you take their money, your other people money that you're making off your items at cash flow, then you go out and buy that G-Wagon, okay?
And also, don't allow an ugly house turn you off. Like, you can put in some sweat equity. Sweat equity is so valuable. And when I say sweat equity, that means you get out there and you do it yourself. Little minor repairs, replacing a toilet, changing paint colors. Don't let that turn you off because it's an easy fix. Oh, so I took my son, so I have a 7-year-old who I bought this 3,000 square foot house before I had him, right? But we went home to my hometown and I drove past my childhood home. And my son was like, "Mom, you live there? That house looked broken. I can't believe your mom would let you live in something like that." And it just blows my mind to just know how far we have came as a people. They don't live those realities, right? But I feel like those hard upbringings are what create us as people, right? It makes you want to grind harder, but you still gotta position those children to where they would still work for you, will work for their future, and not feel like it's just they deserve for it to be just handed to them. So they still have to do things to make sure that they aren't just privileged little brats, right? So, and that's a struggle that we live today. That's the truth that we have to constantly have to think about. How are we going to make sure that these kids earn their keep, right?
You can't have what I call a paying mindset of pulling up to a house, looking at it, assessing and saying, "Oh, it's broke. I don't want to invest in that property. I don't want that house," right? When in fact, actually, he's a very unique kid too, by the way. But she also takes him to other properties too, where he's able to go in and assess what needs to be done to the property too, right? So if a child can say like, "Oh, it's broken," walk away,